All right, hello everyone, and
Yep, ready to go.
Thank you for coming in. Welcome to
Yes.
OWM Live, our first doing of a webinar. So thanks for everyone for attending. This is going to be an update and review of where things currently stand as far as the markets and the crisis that we're in right now. I'm Jared Jones, Investment Director for Omega Wealth Management and Associate Financial Advisor. I have with me Lisa Kirchenbauer, President and Founder of Omega Wealth Management. And behind the scenes is Kathy Frakes. She's going to be looking at everyone's questions. You guys should have the ability to ask questions as you have them. If you have any problems, Kathy will be there to help assist you as well. We wanted to touch on a couple of the housekeeping items as far as GoToWebinar. You won't be able to see any of the other attendees. You won't know who else is on this call. We did that to maintain client anonymity. I can't say that word. So that's why you're not going to be able to see anybody. You'll just be able to hear Lisa and I talk today. So let's go ahead and jump into this. We have a quick disclaimer. Lisa made me put this in. Things are evolving rapidly, so this basically just tells everyone that whatever we talk about today is based on today's views. People and things are changing constantly, so quick disclaimer up front. So first we're going to talk about where things stand currently, then we're going to talk about what we don't know, what we do know, talk about a little bit of the performance as where things stand as of yesterday. Obviously, we're getting a couple big days in the markets and things are changing pretty rapidly. We're going to talk a little bit about what Omega Wealth Management's doing, a little on what SEI, our main investment partner, is doing right now, and then some things that you guys as clients can be focusing on, because one thing we know is that everybody wants to feel like they need to do something right now. This is a big amorphous problem. We can't wrap our heads around it. But one thing that's constant for everyone as we see and talk to clients is everyone wants to be taking action, but they're not sure what to do. So we're going to talk a little bit at the end about things you guys can be doing. So all of that should take about 30 minutes or so, and then we're going to open it up at the end for questions. Like I said, Kathy is manning the question desk. She's going to be flagging some as they come in. She'll be trying to respond to a couple as well. So let's dive right in. So where things stand currently, we were watching CNBC and Mohammed El-Arian said it best. It's like drinking from 3 fire hoses at once right now. So the 3 different fire hoses are health, financial, economics, and we could even throw a little bit of politics in there for good measure, just to make everybody overwhelmed all at once. So today we're just going to focus on the investment side of things and primarily what Omega Wealth Management doing and what some of our clients are experiencing. We're going to stay away from the health side. Lisa nor I are medical professionals, so we feel we're not qualified to comment on where things stand as far as the coronavirus. So anything you want to add, Lisa, before we get going into the slides?
Yeah, I want to say that, I'm sensitive to the fact that this is not like any other event we experienced. Exactly to what Mohammed El-Arian is saying, is that if you imagine back to 2008, 2009, you could still go to restaurants. If you had the means, you could go to a movie. You were out and about, you could connect with friends and family, and we can't do any of those things. This is so different and so unprecedented, and I think we need to appreciate just how extraordinary this is and why it creates a sense of really being unsettled. And then, we have a number of clients who are in various kinds of transitions. And perhaps they have already been transitioned to retirement, perhaps they're about to, or maybe they're already living off of their portfolio at a younger age. And this can feel very unsettling. As Jared said, eating nothing, you keep hearing us say that, sounds really rational and logical, and we understand that it's not that easy. And as one transitions to a time, we know that it's certified financial transitions, it can feel very out of control. And we're sensitive to all that, and we want today is really about giving some perspective on the financial markets, in a general sense. But as we're going to continue to say to you, we're happy to talk with each and every client because each situation is different. There's not a one-size-fits-all answer, although we'll talk generally about it today. We understand that each client has different questions, concerns, and circumstances.
Yes. So let's talk a little bit about what we don't know at this point in time. If somebody says they know the answer to these things, I'm going to say they don't. This is still a big question mark. We don't know how long all of this will last. We've seen some optimistic views, some pessimistic views. Nobody knows for certain. This is uncharted territory. We don't know how bad things will get, and we don't know what recovery will look like. Whether that's being an explosive versus sluggish, again, that's something that's very popular right now to be speculated on. I will say that the average time since World War II of recovery takes to get back from peak to peak after a trough is 317 days. That's the average time just since World War II. So we don't know how long it's going to take this time. This time is certainly different than any other time. We hear a lot of people trying to compare this back to the great financial crisis in 2008, 2009, also looking back to the Spanish influenza. It's neither of those things. It's a little bit of both wrapped in together, and this is uncharted territory right now. Lisa, do you have anything to add there?
Yeah, I want to add one other point, which is I know there's a lot of talk this week, and the market has been moving up and down on it, of stimulus. I want to be clear that it's not stimulus. It is market and economic stabilization. The reason our political leaders are taking this, and the Federal Reserve is taking all of this unprecedented action, is to stabilize our economy and our financial markets. There will have to be another round or two rounds of actual what is called stimulus, meaning that we're really going to get the economy going. All we're trying to do right now is stabilize. So I think that's important because I know that we've been watching it move on hopes of stimulus, and here we are, it's Wednesday and we're still hoping. That's some of the ways I think we all need to start to shut out. They need to get this done. We do need to stabilize the economy and then deal with the health crisis and see where we are. So that's why we're left with a lot of what we don't know issues at this point.
Yeah, I saw a nice tweet earlier this week.
So what do we know, Jared?
I saw a nice tweet earlier this week. It said, take care of the people and the economy will be taken care of, versus 2008, 2009, they really had to take care of the economy to take care of people. So just thought I'd throw that out there. And I think once we get a plateau in the number of coronavirus cases, that's one thing that everyone is looking forward to. That's really when we'll know how bad this thing got and really get a sense of what recovery will look like at that point. So what do we know? That is a good question. At this point, we know for sure Q1 is bad. We're going to be in the middle of that. We're going to talk about some of the performance numbers currently. We're fairly certain that Q2 is going to not look great either. I don't think we're going to be all ready to jump back into life as usual this summer. Maybe by the end of the summer, things will change, but we're thinking Q3 might be ugly as well, as far as an economic and financial concerns go. We're fairly certain it's going to get worse from here. One thing that hasn't happened yet, that is about to happen tomorrow, is we're about to get concrete economic data tomorrow morning as the first round of unemployment numbers come out since all of this began. We're really expecting it to look like typos. We're going to see numbers that we haven't seen really since 2008, 2009, and it honestly might be worse. We're not sure what it's going to look like. We would not be surprised if we have bad data come out that it's a bad day in the markets. We've gotten two back-to-back positive days the past 2 days for the first time since February and when this all started. And we've seen some pretty dramatic down days along the way. We would not be surprised if unemployment numbers are rough, that we would have a pretty big down day tomorrow as well. And to end.
And that's also one half, right? It's only one half of the equation. The other piece that we're going to continue to see get worse are the numbers on who's infected with the virus in our country. So tomorrow will be the beginning of the economic and financial actual data. Remember that our market has moved down basically on fear and what's been happening in other places in the world, not on actual data yet. And then we're going to get the other piece as we continue to do more testing. And of course, right now, because they're doing testing of the people who are symptomatic, the numbers will look bad on the testing and who is ending up positive with the virus. So I think we need to be prepared for a lot of continued volatility in the markets, definitely some more down days before we get on the other side of this. But is it ever going to end?
Yeah, no, for sure. That's one thing we can say for sure, that this will end. We don't know when, but we know it will end. If we look at viruses across history, they all end. That's one thing we can say for sure. So we will get on the other side of this thing. We're big optimists as far as human ingenuity, and we'll come up with a way to get through this. So that's one positive thing we can move on to.
It doesn't mean, right. It doesn't, and we're sensitive to the fact that it doesn't mean that it's going to be easy while we're in the middle of it. We're not going to say to, relax, don't worry about it. There are reasons to worry about our own health, about our family's health, about our livelihood, about our income, about our financial well-being. So while we are optimistic that things cycles. For many of you, you heard us say for the last year or 2 years, everything moves in cycles. Well, now we're at the negative part of the cycle, and at some point there will be a recovery, but who knows how long it's going to take to get there. And living in that uncertainty can be challenging.
Yes. So let's talk about where things stand right now. This has been the fastest crash ever in history. So we've talked to a number of clients saying this time feels a lot different than anything that we've been through. You're absolutely right. This is unprecedented. So don't feel bad if your head is spinning right now. If we take a look at this chart here, it's showing the past 30% sell-offs throughout history and how many days it took. So this one took 22 days to get to 30% down. That's beating, it's up there with Great Depression numbers. If you look at 1987, a lot of our clients probably remember 1987. I think Lisa was getting started in the industry back then. This is about half the time it took to get to where we were in 1987, where we are right now. So this is truly unprecedented. And Lisa, you some of these dates probably look a little familiar to you. Why don't you touch on that?
Yeah, I mean, I have been, I was a trading desk from October of 87. Certainly remember that day quite well. And 0102, sometimes, we've started in our financial planning numbers to talk in terms of bad timing using the back-to-back negative years of 01 and 02 as our bad timing scenario. And you can see 2000's on there, 2002 is on there as well. And then, of course, what many of us and many of our clients have been part of with us is 07, 08, and that whole experience. It's not a lot of fun. It is, and there comes a point, I remember on March 9th of 2009 thinking, maybe we've got this wrong. Maybe being diversified isn't the answer. Maybe we should be doing something different. And that was the bottom of the market. And so I have to tell you that I'm not getting that feeling, unfortunately, yet where, yep, I don't know anymore. I just don't think we're at the bottom of this. So we've had a fast ride down. We both believe that there's probably more downside before there is upside. And often you get to that point where it just seems like it can't go any lower. That is often the bottom. When everybody starts to throw up their hands and think this is never going to end, that's often the bottom. Unfortunately, I don't think we're there yet.
We're going to talk about a little later on how hard it is to call the bottom. We've got a chart that will illustrate that. And this time is unlike, we've already talked about this, it's unlike any time in history. So it's going to be near impossible to say, okay, this is the bottom. Like Lisa said, we don't think we're there yet. Yep. We probably have a little ways to go. But so let's talk about why markets are so volatile right now. Really, there's a couple of different factors. Obviously, the first one is coronavirus. When the economy shuts down, that's going to put a damper on the markets. We also saw a collapse in oil prices. We know oil prices are highly correlated to the markets, and we've also seen a decline, a sharp decline in yields. The 10-year is below 1%. I don't know if that's ever happened before. It might be the lowest it's ever been. So all of this is happening concurrently. So that all causes extreme uncertainty. And if there's one thing we can say for sure is markets do not do well with uncertainty. We get stuff like this happening when all three things like that happen at once. So the other thing that we know is when markets are very vulnerable like they are right now, a thing like headline risk pops up. Any headline that we see coming out of the news, we saw it, markets trading on the optimism that a deal might happen. We saw that yesterday. The deal went through today, so we saw another little bump, but it was nowhere near as dramatic as just the optimism headlines that come out that something was going to happen. The other thing that's causing this extreme volatility right now, that's unlike back in 2008, 2009, is how computerized trading has become. A lot of institutional investment management firms have set algorithms to trade on different varying topics, crossing below moving average numbers, headlines, even looking at draws out of the market, money into the market. Who knows what it's all trading on, but algorithms and the speed of trading has become so fast, and we're really seeing that pick up. I have a graph here on the right-hand side indicating the VIX. That shows a spike. You probably hear this on the news. It's called the fear gauge for the market, and you can see the high spike on the left-hand side of the graph is 2008, 2009. So we're inching up towards that with the VIX index. You've probably heard about circuit breakers as well. So the circuit breakers were put in place back, I think, after 1987, right, Lisa?
Yeah, after 87, because obviously the bottom fell out. We went down 22% in one day. So I put them in place in 08 or in 1987, but then they revised them after 08, 09 to the numbers that you see there, the different levels that you see there. And we've already experienced that a number of times. Plus, we've had the futures in the future market trading overnight. There's a different circuit breaker that is if they go up more than 5% or down 5%, limit up or limit down, that means then you can't even see what the futures market is trading. And so then what everybody starts looking at are exchange traded funds to try to understand what might happen once we officially open at 9:30 Eastern. So Jared, you want to walk us through the new circuit breakers that we have?
Yeah, so level one, we hit the first level one a couple weeks ago for the first time since 1997. So we didn't even hit it in 2008, 2009, which is kind of crazy. So, but they were revised, I think Lisa said. So first time since 1997, level one was hit. If there's a 7% decrease in the S&P 500, it will halt trading for 15 minutes, kind of a rest period. I was a big swimmer back in the day, so the lifeguards would blow the whistles, everybody out of the pool, catch a breath. That's what happens in the markets. Then they reopen trading. The market has to go down to 13% for another halt in trading. That's level two. And then if the market declines 20%, they're going to cut trading off for the whole day. Luckily, we have not seen either level two or level three, but those are the different circuit breakers in place to put a backstop on kind of volatility that we've seen. So just look real quick at where things stand. We've had a couple of good positive days the past 2 days. The 5-day numbers look great, but you can see the 1 month numbers are pretty dreadful, and the year-to-date numbers are pretty dreadful as well. So to put a little perspective into this, on Monday at the lows, at the bottoms, we were down 28% on the month. That's the worst month since 1931 in the Great Depression. If we look back to 2008, 2009, the worst month was down 14%, and we were twice as much as that. So this really is an extreme event, unlike anything most of us have ever seen. So that's where we are right now. We know it's not pretty. but we're urging our clients to stay in there. And we're going to talk a little bit next about what we're doing, how your clients' portfolios are constructed, and some things that you can be doing. All right, so this is Lisa's slide here.
And I want to add a couple of other points here that are important. Yeah, and well, let me say one more thing. Actually, Jared, can you go back to that other slide? I want to just make a couple points there that I think are important. One thing is that for the last few years, U.S. markets have outperformed international markets by a decent amount. Now, obviously, this virus is moving around the globe. Europe hit before us, and a number of Asian countries being hit before us. But you'll notice that the numbers are not that much different between the U.S. and international. So that's really been a shift. And if you look at the 5-day numbers, you can see the internationals have actually been stronger than the U.S. Obviously, bonds have been a good ballast. So, this also makes the case for being diversified, trying to guess which asset class should I be in U.S. stocks? Should I be all in bonds? Should I be in international? Is a hard guessing game in volatile markets. That's why we think it's important to be well diversified throughout, because you really just don't know which market is going to perform well. Thanks. I just wanted to make that point. So then what I have also been saying, is that in a way, what this has felt like, I think, especially in the United States, has been one of these like super hurricanes, a Cat 5 hurricane that we've been hearing about for 2 weeks. It's coming, it's building up speed, tomorrow being probably the first set of real economic numbers that we're going to see as far as the impact. We're hoping theres an eye in the middle of this, but then you get hit again with it. I think that's important, just to recognize that this is the anticipation. We've been going down on anticipation, not on actual data. And now we're going to get the data, and it's hard. The good news is, though, that we've been, and Jared will talk more about this, we've been preparing for this for a while, just like people who live in Florida or in other areas that are on the coast. You're preparing for hurricanes all the time, so that when it does come, you're ready. And we do feel that, and we've tested these folios, that not just now, but in 2008, 2009, we tested out the concepts that we're going to talk about, reiterate today. So this isn't new for us. We've been through this, and even so, it can be hard anticipating that storm and then bracing for that storm and taking on those winds and the rush of water, the surge. We know that. So just to normalize that a little bit, the good news is that we've been preparing for the storm for a while.
So if you're a client of Omega Wealth Management, this is our pools of wealth, and you've seen this countless times. Lisa, why don't you talk about how long this has been around?
Yeah, so we started to put this concept into place in 2004, especially as we strengthened our relationship with one of our investment custodians, SEI, who also take goals-based approach. And goals-based means that rather than just putting all your money into, an array and maybe an individual or joint investment account, we actually set separate accounts for different goals based on the financial life work that we've done for you. So you can see that, and the key is that the shorter the goal and the more important the goal, the more conservative and that we're going to be with how the money's invested. And then we've got a longer time until the goal. Let's say you're not at retirement yet, retirement's coming in 10 years or 5 years or whatever. We can afford to be more growth oriented with those monies. But let's dive a little bit deeper. Jared, maybe you can take us a little deeper in what we're doing and where our focus is at this point.
Yeah, so you can see our current focus is there outlined in the current lifestyle/emergency fund box. in times like this, we feel really strongly that it all starts with making sure your personal finances are secure. And that is making sure that you have enough cash on hand to pay your bills for really the next 6 to 12 months, depending on where you are in your career, where you fall in your tolerance for risk. Obviously, if you're not working, you're not earning that income, you don't have that Cuban capital that you might have relied upon in previous recessions. We want to make sure that you have more cash on hand so that you're feeling comfortable. Our main goal, we're going to talk about this, is to keep our clients invested throughout this storm. So it all starts, our current focus right now is building up the cash that clients have on hand. If we know you're in distribution phase right now, we've been in touch with you and we feel like we have at least a plan in place. If not, you have enough cash on hand already. We also like to throw up a wall between the two. Yeah, go ahead, Lisa.
Let me just add a little bit more. Yes, we want to keep the longer term portfolios in the 6 to 10, but especially the 11 plus years invested, especially now so they can recover. Obviously, we don't really want to sell when your portfolio is down unless there's a good reason for it. Unless we're trying to harvest losses for tax purposes, or we're moving to a new investment strategy and we want to buy in cheaper. Otherwise, our goal is to let those monies recover. And by if we have enough money over on the left-hand side, the less than 2 years and the 2 to 5 years, we can afford to let those recover. So that's what we're going for, to be very specific.
And Lisa, talk a little bit about how you saw this play out back in 2008, 2009 with our clients, because you had this in place for the recession.
Yeah, I mean, we did. We had put, started to get in place in 04, but then really had it in place for 08, 09. And, what it allowed us to do, if you remember back, we went into, the period of time where we were down. 08 was a down year, significantly more than where we are right now. And then we had a big recovery in 09. But that period of time, was really less than a year. It took a little longer, a year or two, depending on how you were invested, to recover. So it worked really well to be able to only draw off of the short-term accounts and to let everything else recover. And yes, it takes some time to recover, but it happened. And for the most part, although we had a little bit of selling during that period of time, we were able to keep everybody invested. And Jared's going to talk a little bit more about specifically what SEI does with those stability focused strategies in the 5 years. I hope that will, give you some peace of mind as well.
So our clients know that we've been in conversation with you really at every meeting we've had for the past 4 or 5 years about your overall asset allocation and your risk tolerance. So we're working constantly, not just in times like this, but really all times, to make sure you're invested as we feel is appropriate for your risk tolerance. One thing that we do know is that likely during times like this, your stated risk tolerance is actually probably a lot lower than what we think it is. People tend to, our risk tolerance is a fungible thing. It moves given our circumstances. So that's one thing that we know, and we design portfolios going back to the pools of wealth method based on that knowledge. So that's one thing we're checking in with, and we're going to understand and work with you if course corrections are needed. And we may have been in touch with you already, or we might be in touch with you in the next month or weeks coming if we feel like the strategy is a time to change. It probably gets a little old hearing us say, just remain the course. You're good right now. It feels scary right now. So we know clients want to be taking action. Just know that we're reviewing everybody's portfolios constantly. We're looking at your pools of wealth, making sure that you have cash on hand if we know you're taking distributions. So we'll be in touch if we feel your course corrections are needed.
And we welcome your calls, emails, requests for one-on-one video calls or audio calls.
Absolutely. So let's talk a little bit about what we're doing and have been doing really over the past couple of weeks throughout this. We're reviewing individual positions for our clients weekly, if not more frequently in times like this. And we may be in contact with you if we think a position is really a time to get out. It's time to get out. So some of our clients have already heard from us on this. Some of you might hear from us in the future, like I said. So we're reviewing positions quite frequently. We're also reviewing our market contingency plan. We put this in place back in 2016. It actually came from Mohammed Al-Arian, who we quoted at the top of this presentation, and what he did with his firm during the financial crisis. They actually had a contingency plan in place. So really the first steps of that contingency plan are getting into touch, whether it's phone call, whether it's an email, a video call. We want to be in touch with people that we know are in distribution phase right now, and we want to be in touch with people that we know are about to have kids go to college or in college. We reviewed all of our 529 portfolios to make sure they aligned with where our clients' children were in their age. If they were in college, we wanted to make sure that they were in a distribution or a very conservative strategy. And for our retirees or people taking distributions constantly off the portfolio, we wanted to be in touch and make sure their cash flow and their cash needs were met. So that's part of our contingency plan. Another thing that we're looking at is now might be the time to invest in a strategy that we've been working towards, but maybe didn't have the opportunity to because of the significant 11-year bull run that we just came out of. Taxable gains were really high, so we were taking our time to work towards a longer-term strategy that we might want to be investing in with our clients. This has thrown everything on its head. Gains are a lot lower than they were a month ago, so we might be in touch with you as well to move towards a strategy that we think is best for the long term. We don't view this as market timing. Some clients might think, hey, are we trying to time the market on this? It's really not. We're not looking to exit the market. We're looking to move to a different strategy. Lisa, do you have anything you want to add on that one?
Yeah, I want to expand on that a little bit because one of the things that you're going to hear us talk more about over this next year, it's something we've been doing for years and years, but we've got more solutions, and that is socially responsible investing. So aligning your money with your values. We've developed some portfolios. SEI has more options, and we know that some of our clients would like to have better alignment with their values and their money. And this may be a perfect time to sell out either at a gain or a loss. And I welcome losses. It's been years since we were able to harvest losses that we could bank for the future against future gains. And then buy in at a low price to what will be the long-term strategy. And again, as Jared sounds a little counterintuitive, do you really want to sell now? Yes, I do, because I want to get you in cheaply to that long-term strategy that you want to stay in. That's ideally what we want to do. And don't be surprised if there's a couple of other actions we may reach out to you on. One would be we may try to do some raw IRA conversions. As some of you may know, Congress has extended the age at which you have to take required minimum distributions from 70.5 to 72. And so at least some of our clients are still they've hit retirement but don't have to take required minimum distributions, but have a huge retirement account that eventually they will have to take distributions fully taxable from. So this is a time to maybe do Roth IRA conversions. Once you do that conversion, you pay taxes on whatever you convert, and then it grows on a completely tax-free basis going forward when you start distributions if you want to. So it's a real opportunity. And loss selling, harvesting losses. I'm already seeing that right now in some of the accounts. Don't be surprised if we suggest you do that. What we often would do is sell, take the loss, and then wait. We have to, if we're buying back into the same asset, we have 31 days or we don't get to take the loss. We call it making lemonade from lemons. We've been handling a lot of lemons quickly, and these are opportunities that haven't presented themselves literally for years. And this may be the time where we can bank some of the losses, get you back in the market before it fully recovers, and then have those losses to offset against gains in the future for good tax planning. Jared, why don't you talk a little bit about SEI's drawdown protection, and I can add that a little bit as far as what we actually saw in 08, 09.
Yeah, so one thing that we think SEI does a phenomenal job with is their drawdown protection, and that's really why we'd recommend some of the accounts that or strategies that we do to our clients. Drawdown protection is when a strategy declines by a certain percentage, SEI is going to take proactive measures to rework the allocation, work in some more conservative assets into the strategy, and make it more stable than it is. So those stability-focused strategies at SEI are defensive, conservative, and moderate. If you pull out your pools of wealth from our last meeting, if you have it on file, and you see one of those strategies, just know that SEI has drawdown protections in place. And we're really hoping that they don't get triggered, but they are in place if they do get triggered.
Now, to be clear, that doesn't mean you're not going to lose money. So it's a point at which they don't want to take any more losses. So I want to be crystal clear on that. That's not they can't fully protect everybody from zero losses. The only way you do that is if you're sitting in cash, and sometimes that makes sense, but in the long run, that generally doesn't. What we saw in 08, 09 was, and a great chart that we could always pass around, is that they, as we through the financial crisis in the fall of 08, they actively on the defensive, conservative, and moderate strategies actively went down to much more short-term money markets, even less bonds. All of those strategies have some stock in exposure, but not a lot, not as much as long-term strategies. And so they are preparing us for the possibility that that may start to happen. But as Jared said, it hasn't been triggered. We hope it won't be triggered. But that's why we have shorter term money in what are called active strategies, as opposed to exchange traded fund or index funds, which are what are called passive, meaning you're just following an index. These strategies, these stability focused strategies, are active strategies on purpose. This is the money we want to take action on if things get really negative and really frothy. Again, hope we won't see them have to take that action, but that's why we're those strategies for the term goals.
And you might be thinking, looking at the numbers that we showed you at the beginning of the presentation about where things stand year to date, why they haven't been triggered yet. These strategies are way focused on stability. So they're nowhere near at the drawdown levels that we're seeing in the Dow or the S&P 500. The last thing that we want to talk about with what we're doing right now is we are available to talk with you. If you have felt, if you haven't reached out to us, you felt nervous about reaching out to us or thinking we're a little too busy, we need to hear from you. We want to hear from you. We have time. We can make time to talk with you. It will give us peace of mind knowing how you're feeling right now. So don't hesitate to reach out and talk with us.
And there are no dumb questions. I know we've had some clients say, is it dumb for us to want to make a change? And the answer is, it's your money. We're going to help you make the most educated decision that we can. We're going to, take a look at your overall strategy. We're going to look at the planning numbers where appropriate. This is bad timing potentially. For those of you where we've been running regular planning updates, this is bad timing, or the bad timing scenario. And we're going to try to brainstorm with you to figure out what are other actions you can take besides touching the portfolio. But if in the end you feel that's the best thing to do, okay, we'll respect that. That said, I think what Jared wants to share with you is, well, trying to time the market, there's really two parts to it. So why don't you walk us through that if you can?
Yeah, that's great. We've heard a lot of people come to us and say, hey, if I get out now, why can't I just invest at the bottom of the market? Well, we know getting out is kind of an easy decision to make, right. But when we look at history, we can tell exactly how hard it is to time the bottom of the market. So deciding to get out also requires a critical decision of when to get back in. The chart here on the right-hand side, so average cost of missing the trough. So at the bottom of the market, what's the average cost if I miss it by 1 month, 2 months? You can see there, if you miss that bottom by 1 month, the average cost to you, the loss that you've locked in is about 10% on average. You can also say if you miss the top over on the left-hand side, it's a little bit less steep than it is at missing the bottom. So getting back in at the bottom also requires extreme intestinal fortitude. And if you miss it, that's when the real cost happens, not the paper cost that we have right now, the paper losses.
So it's often best to, if you do have money to invest and it's long-term money, we at this point would systematically put that into a long-term strategy, not even attempt to try guess, is this the best day? We won't know what the best day to invest, i.e. the worst day of the markets are, until it's long gone. As referenced before, March 9th, 2009, absolute bottom of the market, Dow it's 6,500, if anybody can remember that. I can tell you that there were virtually no clients who were willing to invest. And bless some of you who have actually reached out to us and said, hey, I've got some money, I want to invest. What we would at this point recommend is systematically putting it back in, because we don't know where the bottom's going to be. And in the long run, you'll be fine as long as this is for a long-term goal.
Yes. So we know that clients in times like this really feel like they need to be doing something. And a lot of times touching the portfolio is not the right answer. There's no cookie cutter advice out there, but a lot of times touching the portfolio is not the answer. So Lisa, why don't you talk a little bit about what clients can be doing right now?
Yeah, I mean, so this was Jared's idea to put this out. I'm not taking responsibility for this first bullet. So socially distancing yourself from your portfolio. Honestly, we've said to a number of you, we've asked as we've had meetings, do you want to know the returns? Remember, these are a point in time. From day to day, it's changing quite a bit. Don't be surprised if we send an email in the next week or so that says, don't even open your statements. For those of you who've been with us for a long time, remember back to 2008, 2009, and there were several times where I said, just put them aside. Don't open them right now. They're just a point in time. That's what you have to keep in mind. This only turns into real losses when you sell. I know that sounds trite, but it is true. So this is a great time to practice social distancing from your portfolio. What can you do? And many of you have been doing this, looking carefully at your monthly budget, looking at what your cash needs are going to be for the rest of the year. Unfortunately, for many of our clients, the travel that they had planned for the year, it has gone out the window. And we're all basically going to the grocery store, the drugstore, maybe getting gas and buying stuff on Amazon. So I know everybody's cash flow is changing. Oh yeah, Netflix. Sorry, I forgot about that one too. So, this is a great time if you want to take control, is look at what cash needs are and let us know, especially if it's a change from what last conversation. We're also trying to communicate with you frequently, hopefully not overdoing it. We're trying to pace the communications. We're also posting on our new OWM website a lot of materials, investment materials from our investment partner SEI. We think there's some really good materials, so you might want to look there too, not just be paying attention to the emails that we're sending out. And then the last one is, as financial life planners, we really think, and I'm going to say this, detach. And it doesn't mean that you don't care or you're not paying attention, but being able to separate from what is happening to my portfolio is me. They're two different things, and your ability to, we know this, to get out there if you can. Some of us are in places where you're almost not allowed to go outdoors, but if you can, get some exercise. I'm back to home yoga at this point. I know Jared's doing his own exercise routine at home. Meditation, we're big believers in meditation. That I have to tell you that I've really built a solid meditation practice over the last 2 years. And I do see that it is helping me approach this whole financial and health crisis a lot differently than I did 11 or 12 years ago. And whatever it is that you need to do for stress management, if it's reading, if it's just picking up the phone and connecting with people, at least, from a distance, it's really key, because otherwise, when you aren't able to do these things, back to Jared's point, often you start looking around for action to take. And what seems like a great strategy right now may not be a great strategy long term for you. But we'll look at it with you. We want to give you options, and again, help you make the most educated decisions you can about how to move forward.
And to wrap things up, I've got a couple of doodles here from Carl Richards. He posts these in the New York Times occasionally. He's from Behavior Gap. He's a behavioral economist. So I really think that this work kind of sums it up. So the first one is, we all have the feeling as human beings, we all want to get in. We don't want to miss the top. So as soon as markets are topping, we feel that sense of the urge to buy things. And as soon as it gets as bad as it is, maybe now and what's to come, we have fear and we want to sell. So if we follow that cycle, we're going to repeat it until we're broke. And then the other one is this one rings true for right now. I think if we focus on movements in the markets by days, we get that feeling. We see the big increases, the big declines, and it feels really stressful. If we take a step back and look at the broader picture, some of our clients might not have decades to let their accounts recover. But even if it's 1 year, 2 years, 3 years, the moves in the markets are a lot smoother. So step back from the day-to-day movement, turn off CNBC, turn off the news, and focus on a bigger picture. And with all that said, we're going to open it up to questions. I'm not sure if we have any coming in. I know Kathy's been watching.
Jared, we do have one that I answered firstly, but we'd like to know, when you talk about systematic investing, are you recommending investing in equities in equal amounts for 3 months, 6 months, or a longer period of time?
Yeah, it's a great question. So
great
do you
question.
have any thoughts there?
Yeah, so if I heard correctly, how long a period of time? And that's a good question. This would probably be a good time if we were systematically putting money into a well-diversified portfolio. Probably at least over the next 6 months might be good. There's no telling how quickly the recovery is going to come. I guess I would say if you're worried you're going to miss out, then maybe 3 months. But the other key is to make it systematic, i.e. automatic, as opposed to trying to time the market and, is this a good day to get in? If this isn't a good day, we would really recommend that, maybe you say the 1st of the month or the 15th of the month, but make it automatic. Just like for those of you who are still investing in 401ks or IRAs, that ongoing approach, which gets the emotion out of it. And then to be able to step back a couple of years from now and, hopefully feel pretty good about the decision you made.
Yeah.
Kathy, do we have any other questions?
No, I open the floor to those. Let's see. Will you please share your slides with us? Yeah. You got it, Jared?
Yes, we will be sending out a thank you email for everyone that attended, and we will be attaching the slides. We're also been recording this webinar, so we'll post that on our blog. Everyone will have the chance to rewatch this if they'd like as well.
Great.
There are a couple more questions, Jared. Do you see them?
Anyone else have a question?
Yeah, we got a question here. It says, what actions, if any, has SEI advised you that they have done beyond their drawdown strategies?
So one of the things that, to keep in mind, if we have many IRA accounts in exchange traded fund strategies. What SEI is doing for you is automatically rebalancing. Now they're going to be rebalancing the middle of April. Is that right, Jared?
Yes.
So that's something they're doing on a regular basis.
Yes. Yeah, our normal rebalancing period would have been March 30th due to all the volatility. SEI said, okay, we're going to take a step back. We're moving rebalancing to April 14th. So that's when we'll rebalance. And we're proponents of rebalancing. We've set asset allocations with our clients based on the long term. So we call it rebalancing into the pain. If equity positions have declined because they're going down in value, we think it's prudent to re-up and get into that allocation that we've set with you. I've got another question here. Should I assume I'll have to wait? Oh, sorry. You're going to say something, Lisa?
No, go ahead. Go ahead, Jerry.
All right. We have a
Go
question
ahead,
here.
and move on with the.
Should I assume I'll have to wait longer to retire? And should I be changing my mix to greater cash, less risk over that term?
So bottom line is that there's not a one size fits all answer here. That's why we update our financial planning numbers for most of our clients every single year. And we're always reassessing the investment strategy. So the answer may be no, you can still retire. I mean, if your numbers have been looking really good, we've already built in a bad timing scenario, and we've done the Monte Carlo simulations that looks at randomized good and bad returns over a period of time. So I know it can feel like, shoot, I shouldn't retire right now, but I would not say that that's an absolute don't retire. We need to look at, run the numbers, look at the portfolio, understand your cash need, and then help you make an educated decision for yourself that you can be comfortable with. And I want to say one other thing about, what has SEI said to do anything else? I can tell you that most likely SEI is never going to say, sell everything. They're not going to, and they're going to is that we know from looking back over other down periods, the worst thing you could do right now is sell, especially for long-term goals. Now, do we need to tweak things around the edges for your short-term goals? Absolutely. One of the things that we're going to start to work, and I didn't say this earlier, we're hitting the period of time, and this is for my two sons, we're hearing about college decisions, seniors in high school. We're going to know exactly how much money you're going to need for college education for that first tuition payment in July. So in some of those cases, we might take some of that money to cash because it's coming up so so it's all going to depend on your particular circumstance. There is not a one size fits all, and SEI is most likely never going to say sell everything. I remember back in fall of 2007, the bond managers were very negative. It was a volatile time in the markets, and they said these equity managers, the stock managers, are having a great time, but we think something is coming. They even say we're going to cash, we're selling everything. But what they were looking for us to do, and we are looking to do for you, is to figure out what is the best mix for you for your particular circumstance.
Sorry. Not mean to go back to the previous slide. We've got another question in that vein, though, Lisa, that I've been hearing quite a bit. This thing, that the strategy we're talking about remaining the course, makes sense intuitively to our clients. At what point does that evergreen strategy change? Is there a point where we go into a depression versus a recession that our tone will start to change for our clients, or recommend a different strategy?
I think there's going to be, as you said, there are going to be some course corrections. It's all going to depend on how much money you have sitting in the 0 to 5 buckets, and how much you're spending. Even when we look at, I think, the Great Depression, it didn't go on forever. Yes, it did take a long time to recover. The other thing that we should mention, and we haven't said, is that worst case, let's say this goes on for longer than we thought, and we've started to run through the cash and all the short-term strategy buckets, and we don't really want to replenish fully, i.e. sell out of the long-term strategies to move money to the short-term strategies, because that is how it works. What would we do? Well, the first place we would go is in most, even the long-term portfolios, there's some cash, and there are bond investments. And the bond investments, although they're not doing great right now, they're still down less than stock investments. And so that would be our next backup. All right, well, let's not sell the stock investments now. Let's let them recover. Let's pull from the bond portfolio, and then things recover, we can rebalance totally. I know it's hard to hear this, like how we aren't going to know. There's no way to know. And for many of our clients, they can't afford to sit out for the rest of their lives for another 5 or 10 years. That was a real problem after the financial crisis. There was lots of money sitting on the sidelines in in 09 when we had a big up year, in 2010, 2011. Those people locked in losses and never made it up. Then again, for some of our clients, they don't have to take as much risk. And so that's something we need to talk with you about. We can de-risk some of the portfolio. You need to understand what the trade-offs are. We're not going to try to time back into the market. But if your planning numbers look really good, yeah, maybe we just de-risk the portfolio, and that's okay. So, you know, even thinking in terms of, and I am a little nervous about, could this be a Great Depression? It would be hard pressed to say, sell everything, sit in cash, and hope that we can guess when to get in.
We got another question from somebody, just not really a question, but a request to review the stability strategies. So again, they're defensive, conservative, and moderate. So to get into the nitty gritty of how it works, if the defensive strategy declines 10%, SEI will take proactive measures. They'll get out of the riskier assets and go towards more risk-free assets. And then the drawdown levels for conservative, I believe, are 20%, moderate are 30%. We're not at that levels yet. So we have a little bit of a ways to go before those kick into place, but that's where the stability strategies lie. Another great question, is there anything we should ask of our employer 401k administrators right now?
Well, so this is an interesting question that we've been going through here at Omega. Number one, keep investing. Please keep investing. If you can keep putting money into your 401k, yes, into the stock investments, yes, into the allocation we've recommended to you, please do it. Small business owners like Omega, like me, are at a point where often this is the time where we're going to put in our profit sharing or our safe harbor contribution on behalf of our employees. And so one of the things that I'm thinking about is, how can I get that money to into my employees' 401k plan so that they can buy cheaper right now. So we would not say, do not stop putting money in your 401k, 403b, thrift savings plan. Please keep investing. You are getting the opportunity to buy cheaper. Things are on sale. This is exactly what you want to do. It's just, you know, if you go back to the doodle that Jared was showing, we want to buy low. So unless I missed the question, keep investing. And if your employer has money for you, either as a profit sharing or a safe harbor contribution, please, you know, ask them to go ahead and get that money into your 401k so that you can get it invested.
All right, I think we have time for one more, and this one is
Any
a
other
big
questions,
one.
Jared?
This one's a big one. So why do you think bond funds are reacting the way they are?
Oh, wow. That's the $64,000 question. By the way, this the other thing we've been telling a few clients, I know it seemed a great time to refinance. I can tell you, I'm trying to do it right now. Our mortgage broker said that rates are not where you think they are. They are not necessarily lower. Mortgage brokers are being slammed with everybody trying to refinance. What makes this more complicated is the amount of money that the Fed has been pouring in to the system, and what's going on between banks and the Treasury, and putting Treasury securities out there. Just as a reminder, when yields go down, prices go up. If everybody is buying, trying to buy Treasury securities, then yields, in fact, we saw there was a headline today that they technically on the shorter term, I think, went negative. And who knows if that will hold. The bond market, you know, the markets have been moving so quickly. Bonds generally are a slower, sort of turtle-ish investment. And bonds are having a hard time keeping up from a pricing standpoint with the demand and with everything that is going on, you know, with the Fed and with the Treasury. So it's a little wacky right now. We've, you know, seen some negative bond values. Again, they're down less than stocks, so there's still a good ballast in your portfolio. we actually might do some loss harvesting of bond investments. Take those losses, sit out, and wait for prices to shift again as rates start to go back up. So yeah, it's sort of a crazy time. You know, you can certainly try to reach out to do a refinancing, but don't be surprised if you don't see the rates that you would have expected, given the fact that the Federal Reserve has lowered their interest rates so quickly.
All right, and yeah, we've seen some actions by the Fed. I think the bond market was the Wild West there for a little bit, and the Fed has stepped in to shore things up, and we've seen they've done it across different categories. So we saw mortgage-backed securities in the muni market get shored up by the Fed, and then they really started trading like they should be. So that's definitely something we're paying attention to. The Fed isn't completely out of ammo. They're still making some adjustments, but we're paying attention very closely to the bond market, because that's really where things are getting a little frothy, maybe more so even than the equity side. All right, I think we're...
Yeah, and you know, let me just say one last thing. And yes, I know some of you are thinking, and we're going to have this big deficit, and what are we going to do about that? You know what, that is phase 2 or 3 out of this. The good news is that our government, we have the ability to print money. We have the ability to help try to stabilize and create liquidity. And then there are going to be some big questions, some big decisions to be had by our government, our administration, and by our legislators on the line.
As long as interest rates stay where they are right now, I think we're in safe territory. But obviously, what is it, $2 trillion? I can't wrap my head around how much $2 trillion are. So it is concerning, but as long as interest rates remain low, I think we're in good shape.
It's going to be more than that.
Yep, going to be more.
Yep.
All right, guys.
All right. So I think we're over a little bit. I want to thank you for joining us. We'll get this out. Please do not hesitate to email us or call us. We're obviously open for business and available to talk and meet with you. And we really appreciate you being here today. And also for your kind thoughts about us and for checking in. That means a lot to us as well. And hang in there. Stay well.
Yeah, keep an eye out. We'll have an email out to everyone with the slides, and look at our blog for the latest thinking. And we'll also post a recording of this webinar there too. All right, stay safe. Wash your hands.
Thanks. Yep.
Nice job, Lisa. Nice job, Jared.
Thank you.